Welcome to the Explainer. You know, in the oil and gas industry, a single turn of a drill bit miles underground kicks off this incredibly complex financial chain reaction. So today, we're going to follow that money trail, all the way from the raw, physical act of drilling to a final number on a corporate balance sheet. And really, that's the billion-dollar question, isn't it? How do you possibly bridge the massive, high-risk physical world of exploration and production with the super precise, ordered, and regulated world of accounting? It's this amazing mix of heavy-duty engineering, cutting-edge tech, and some really specific finance. All right, so here's our roadmap. First, we'll start out in the field. Then, we'll follow the money to see how those huge upfront costs actually get recorded. After that, we'll get into how we actually count the barrels and the dollars, check out the tech that ties it all together, and then wrap up with why this entire process is so critical for making smarter decisions. Okay, so first things first, let's set the scene. We're going to be focusing on what's called the upstream part of the industry. This is where it all begins, exploration and production, or just E&P. Think about what upstream actually means. We're talking about everything from sifting through complex seismic data to find oil, to leasing the land, drilling the wells, and finally pulling the raw stuff out of the ground. As you can imagine, it's a game of incredibly high risks and absolutely massive investments. Now let's talk about the money. The second a company decides to drill a new well, it kicks off this huge wave of spending. And in the world of accounting, that initial investment is all about one thing: capital expenditures, or CapEx. So CapEx, it's basically all the big upfront money you have to spend. I'm talking paying for mineral rights, those expensive seismic studies, the drilling rig itself, and all the equipment you need to build out the site. Separators, tanks, pipelines, the whole shebang. It's all the money you spend now to hopefully make money later. But here's the thing. Before anyone can spend a single dime of that CapEx, all the partners on the project have to agree to something called an AFE, or authorization for expenditure. This is basically the budget for the project. It's the financial green light that says, all right, we're all on the same page, let's do this. Okay, now this is the most important part to get your head around. The second that rig starts turning, the money being spent on it doesn't just vanish. I want you to picture a split screen. On the left, you've got this massive rig physically drilling into the earth. On the right, you see an accountant screen, an ERP system. With every foot that drill bit goes down, every dollar spent on fuel, on labor, poof, it's being recorded. It's being transformed in real time from cash into a company asset, a digital line item called wells in progress. The physical world is literally building a financial asset on the books, second by second. Now, because drilling is so risky, companies have a really big choice to make in their accounting. You can go with the successful efforts method. It's pretty straightforward. If you drill a dry hole, bam, that cost hits your income statement right away. Your earnings might bounce around a lot, but everyone can see what's working. Or you can use the full cost method, where you can bundle the costs of dry holes with your successful ones. It smooths out your earnings, but it can kind of hide the duds. It's wild, right? Just this one accounting choice can completely change how Wall Street sees a company's performance. All right, so let's say we hit the jackpot. The well is drilled, it's a success, and oil and gas are flowing. The financial game totally changes now. We're shifting gears from building the asset, that was all CapEx, to actually running it, which is all about OpEx. And the difference is actually pretty simple to remember. If CapEx was the money to build the factory, OpEx, or operating expenses, is the cost of keeping the lights on and the machines humming. We're talking about things like field labor, repairs, electricity, taxes, the daily grind. And unlike CapEx, that OpEx gets expensed as soon as it happens. So how do you actually turn that physical barrel of crude into cold, hard cash on the books? Well, it's a super precise, step-by-step process. First, you measure the exact volume at the wellhead and adjust it for quality. Then you apply whatever price is in your sales contract. Next, and this is key, the money gets allocated to all the different owners based on a legal document called a division order. And finally, after the government takes its cut in taxes, everyone gets paid. Okay, so remember that huge pile of CapEx we put on the balance sheet? We can't just leave it there forever. That's where this thing called DD&A comes in. It stands for depreciation, depletion, and amortization. Basically, it's just the fancy accounting way of slowly expensing that massive upfront investment over the well's entire life. For every barrel we pull out of the ground, we get to expense a tiny piece of that original drilling cost. It perfectly matches the expense to the revenue. So we've talked about the physical world of drilling rigs and the financial world of ledgers. But what's the bridge? What actually connects them? The answer, my friends, is a really sophisticated digital pipeline. It's a journey, really, a data journey. It all kicks off right there at the wellhead, with all these sensors, SCADA, IoT devices, grabbing real-time data on pressures and flow rates. That data feeds into a hydrocarbon accounting system that figures out how much came from each specific well. From there, a production revenue accounting system applies all the contract rules to figure out the dollar value. And finally, the system automatically posts those final journal entries into the main financial ledger. It's this beautiful automated flow of information. And you gotta know, this tech isn't just sitting still. It's evolving, fast. Just look at this quote from Schlumberger. Companies are now using AI and data mining to get way, way more accurate about figuring out exactly which well produced what. And they're doing it in near real time. And the engine driving this whole digital pipeline, it's incredibly specialized software. Things like SAP's Production and Revenue Accounting System, or PRA. These are the platforms that pull everything together. Production numbers, complex ownership deals, contracts, royalties, all into one unified auditable spot. Okay, so let's zoom out and land this thing. We've gone through all this complexity, but why? Why go to all this trouble? Why does all this integration between the field and the finance department matter so much? Look, this is so much more than just accounting for accounting's sake. When you have good, clean, real-time data, you just make smarter decisions out in the field. Automation streamlines everything and cuts costs. Having one source of truth means better financial control and makes regulators happy. And here's the bottom line. Better data helps your engineers pull more oil and gas out of the ground. It all adds up to a more efficient, more profitable company. This seamless flow of information from deep in the earth straight to the boardroom, it's already a game changer. And it really makes you wonder, right? With data this rich and AI this powerful, are we moving away from financial reporting that just looks backward and into a world where it can actually start to predict the future? Now that is a powerful idea.